Hello and welcome to our latest webinar. I am Tom Foster, Tax Director at Lewis Brownlee. I'm pleased today to be joined by Shaun Dodson, who is one of our senior tax advisors. Hi, Shaun.
Good afternoon, Tom.
Today, the topic is tax planning points, which is particularly relevant as we're heading towards the end of a tax year. And it's normally the case that we like to think about tax planning as we head towards March, but I think this year it could potentially be more relevant than ever with inevitable tax rises in the future as the government seeks to balance the books and recoup some of the money it's had to spend out during the last month or so.
Okay, I think for the first topic then, if we look at payroll considerations to deal with employees first. So what changes have taken place and what do people need to be aware of for the 21-22 tax year?
Okay, so we have, although the budgets, we're waiting for that next week at the time of recording. They did announce before Christmas what was going to happen with personal allowances and tax bands, and they were going to go up in line with inflation. That was fixed as at the end of September, when the rate of inflation was very low. It's only about 0.6%. So short answer to that is next year, personal allowance will go up slightly by £70, 12,570. The rate allowance will similarly just go up by a small amount, covering 37,700. National band likewise will go up just very slightly. So the point at which employees pay national insurance will be £9,568 per annum. And the employment allowance, that remains £4,000. It's worth claiming it's a deduction for employers against their employers' national insurance. But there are limitations to that. It can only be claimed for those who had national bills of under £100,000 in the previous tax year. And they look at that point of view of the connected employers as well. So you be wary about that, and also be wary if you've got other sources of state aid, such as subsidies and research and development allowances, will limit how much.
Okay. And then in terms of the minimum wage, I think there's been some changes there, hasn't there, in terms of the bandings and age groups now?
Yes, that's right. And this is one in particular, it's definitely worth flagging because minimum wages continue to go up. They've increased quite a bit in recent years. So the main rate is going to go up to £8.91, but also of significant and for people to watch out for, the top age from which people will qualify for that £8.91 hourly rate is being reduced to 23 years of age. So employers just have to be careful about that and make sure they don't miss. It's always the case when people reach a birthday, particularly younger workers, you keep an eye on that. I think it's worth flagging as well because we've seen an increase in activity from HMRC in terms of checking employers and that they are paying a minimum wage, that they are complying with these requirements. And when they do that, they also are very careful to look at exactly what number of hours people are working. So be wary if people are doing overtime, and also be wary if workers are required to attend the location and be transported somewhere else, because there might be a view that their working day begins earlier than they actually start work and getting paid, and all those kind of things could lead to a potential underpayment, and there's some quite hefty fines for that kind of thing. So it's really a case of just watch out for the quirks and the rules. People who are paying close to or on the minimum wage.
Yeah, that's fair point. So then on a similar, slightly separate topic, P11D benefits. I think it's always good to go over the general sort of compliance rules, although most people will know them, but just maybe run through briefly the areas that people should be generally mindful of.
Yeah, absolutely. And again, we're looking at this from a point of view as we're heading towards the end of a tax year. So to begin with, what I might bring to attention is quite often some personal items of expenditure might have been funded out of company resources, particularly for owner managed businesses. So just to point out, if you don't want a benefit in kind to be created, then you can make good, you can pay that back, or have it put to a director's loan account. But if you want to be dealt with that way, you have to make good the payment by the 6th of July. So it is a matter of going in there and just what's going on. Also, you can get out of the requirement to do P11Ds if you payroll their benefits, and that can be beneficial. So it might mean that you don't have to put in lots of P11D forms. Could be useful if you've got a private medical benefit, for instance, and a lot of people involved in the scheme. But again, to do that, you would need to make relevant arrangements and have the information passed over to HMRC by 5th April. They need to get your skates on to sort that side of things out.
Yeah. Okay. And then I think one of the more interesting points in relation to 2021 and going forward is the change in rules with electric cars and related equipment. So could we maybe just briefly talk about that and how people maybe's opinion of taking a company car may be different going forward?
Yeah, so it's a fair point that over recent years, the benefit in kind rates applying to company cars have been steadily creeping up, and it's by and large not really worth anyone's while having a company car. But there have been distinct exceptions to this, and one of those is with electric cars, where the government's been keen to incentivise everyone to develop that technology, the electric car with low CO2, something that's environmentally friendly. And we've seen, obviously, the government's got a target that they want manufacturers developing pure electric cars from some point within 10 years in the future. And opportunities presented here because we've had first year allowances for a while now, which means for electric cars, 100% first year allowance can be claimed, which means that the employer will get the relief back in full for a purchase price. But we also have a 0% benefit in kind rate this year for zero CO2 emission vehicles, and low emission vehicles as well, below 50 grams per kilometre, very low rates apply. I expect those rates to creep up, and I think the indication is going to be 1%.
Yeah.
But even so, 1% is particularly attractive. What makes it particularly appealing now for me is I think the manufacturers are starting to make some significant inroads into the technology, and there's some quite reasonable electric cars that people are perhaps more willing to drive. Charging obviously still becomes another issue, and there are again tax incentives to help employers put points at work. Although again, you've got to be able to have something close to home to make it worthwhile. But I think it's worth people potentially looking into.
Yeah, it's definitely more doable than it was a couple of years ago, and a lot of cars are looking more normal now than they used to. So shouldn't be too much of a change for people now, given that the cost isn't sort of exorbitant, and you can charge it up when you get to work free of charge.
Yeah, absolutely. So definitely something to consider if you are minded to go greener sooner than perhaps would require everyone to do so.
Yeah, absolutely. Okay, then. So I think that's the P11Ds. So the next thing we were going to look at was working from home.
Yeah. So no doubt, most people will probably have heard that there's a £6 working from home allowance that's been mentioned, and clearly most people have been required to work at home. We're both at home at the moment. So could you give us a little bit more detail about how that can be claimed and how what the rules are in terms of entitlement?
Yeah, absolutely. So yeah, it's been well published and discussed that people are having to be working from home now more than they maybe typically used to. The key thing to think about when looking whether a claim for the £6 a week is viable is whether your employer is mandating you to work from home or if you're contracted to work from home. If you are simply choosing to work from home, that isn't sufficient to actually be eligible for the claim. In terms of the amount that you'll get, if the employer pays it to you in cash, that is it's a tax-free income. And if they don't wish to pay a cash payment to you, you can make a claim for HMRC to get the money back in relief that way. So if you're entitled to it, it's definitely something everyone should be looking at. And for the 2021 year specifically, HMRC allowing the claim to apply to the whole year, as opposed to previously it was a specified period that work related to home. So it's definitely positive. It's good.
Yeah, absolutely. And again, the key point from my point of view there is just to be able to demonstrate that there's a crime that's been outside of the employee's hands, and that they have, as a result of their circumstances, work at home. And as long as they can demonstrate that's the case, then, as you say, that £6 a week is available to be claimed for the entire tax year. So that could be well worthwhile. Now, we've also got clients who might not be employees. Are there any other considerations potentially for those who are self-employed who want to claim more than £6 a week?
Yeah, absolutely. So for say company directors who wish to make a flat rate claim, they can continue to do so. The way in which it's done is slightly different in that HMRC look at the number of hours that they're spending at home on a monthly period. And then depending on the number of hours you work through a tiered system, if you can demonstrate that those are the hours that have been worked, you can make a flat claim doing it that way. The alternative, though, is you can do it on an actual expense basis. So if the costs that you are incurring from working at home are more than the flat rate allowance, and you can demonstrate that these are the expenses you have incurred, as long as you can do it on a just and reasonable basis, HMRC will allow you to claim more, which there is a more compliance involved and more record keeping. But if the flat rate is somewhat insignificant, it's definitely something that should be considered.
Okay, we've had one or two queries during the past year or so from people who want to do something a bit more substantial, which could involve, say, converting a shed or even putting a brand new structure out in the backyard or garden with a pure purpose, essentially creating a nice working environment. Is there any particular advice that you might want to give in respect of people who are thinking about doing something along those lines?
Yeah, so if you are looking to or have built a shed or something more glamorous at home, if the employer does pay that on your behalf, you need to be mindful that there could potentially be a P11D benefit, as it is something they are paying for you. If you pay it yourself, there wouldn't be a P11D benefit, of course, but something to be mindful of is the way in which HMRC may view that structure for purpose of capital gains tax. So if potentially you're carving out your main residence and saying there's a commercial element there, that could present some issues. However, there are ways to get around it and sort of structure it to avoid any pitfalls. So if someone is looking to do something a bit more substantial, definitely speak to the advisor just to make sure that you have planned it out appropriately and you don't fall into any traps down the road.
Yeah, so it might be just getting an agreement in place between the employer, be it the company, and the homeowner, which then permits the employer to have use of some land on they put it.
Definitely. It's just making sure people just do a bit of forward thinking and assume nothing and suddenly.
I think it's always good from our point of view to have a conversation with people before they do anything or commit anything or spend money, because there are different ways of going about it.
Yeah, no, absolutely. Okay. Next one is maybe not the most interesting or the most exciting tax to talk about, given what it relates to, but given its importance and the need to be forward thinking, is there anything advice that you would give to people in relation to inheritance tax and the things that they should maybe be thinking about the now and the future?
Yeah, so if we're contemplating in relation to end of year planning, then the obvious regular one is making use of the annual allowance, which is just £3,000 gift allowance everyone has every year from inheritance tax. But those who are in a position whereby they've got wealth exceeding their requirements would at least be advised to make use of that, and you give away up £3,000.
And if they hadn't used it, if they missed it last year, say, is that something they can roll into this year?
Yeah, with the inheritance tax annual gift allowance, you can carry it forward 1 year.
Okay.
So yeah, if you didn't do it last year, it means this year, before the end of the tax year, if you haven't made any gifts last year or this year, you can gift £6,000. If you go above that, it becomes an exempt transfer, and then that starts this 7-year clock. People are probably familiar with. But yeah, you can £3,000 without consequence and drop out of your estate. You'll save potentially inheritance. It's worth looking at. But when we then think about planning beyond that, and if people haven't actually perhaps engaged, like you say, it's not the nicest thing to think about, but unfortunately it is inevitable. And I was looking at one this week where I'm potentially doing an inheritance tax return for someone who was a former inspector of taxes at HMRC. And I couldn't help but notice, saw a letter from a financial advisor in which it was documented that she was keen to try and avoid paying anything back to her former employer. And it's that kind of thing. If you engage with it actually during your life, and steps could be taken. But what I mainly recommend people doing to begin with is actually seeing with a status quo what their position is, what their exposure to tax is. Because you might be a bit surprised, you might be a bit shocked. And then once that's been established, we can then consider if there maybe any steps or actions that can be taken to improve the situation. It's normally looking at wealth planning, some later life financial planning, but generally with inheritance tax, it's the name of the game would be to get things out of your estate, or potentially to invest in areas which would qualify for inheritance tax relief, such as businesses, which includes commercial woodlands or companies invested on the AIM market. So plenty of things to be thinking about, and we're always willing to have that conversation. So I think it's one area where you can make huge tax savings.
Yeah, absolutely, and that's the thing with inheritance tax. It's maybe the one that people least think about, but one that potentially has the biggest impact if you do forward plan and take these mitigating steps, that you can potentially save yourself a lot of money with what could be a relatively straightforward conversation with the advisor.
Yeah, absolutely. And one other way of demonstrating the point is that at the moment we've got this main residence rate band in there, and there's a upper threshold for that, which is 2 million, and a requirement that a former family home has to be closely inherited. So you can fall foul of that by actually giving away your home during your life, because if you make a gift during life, you won't qualify for the allowance. Also, you can actually move assets out of your estate before dying to get below the £2 million threshold, and there's no 7-year clock with that regard. So again, if you've got an estate that's potentially just going to go over 2 million, or by 100,000, 200,000, it's certainly well worth looking into that.
Yeah, absolutely. So maybe if we move on to something
slightly lighter.
Yeah, something lighter and something definitely relevant to the year we've had, and go through maybe the points that people.
Yeah, absolutely. So we're going to be looking at self-employed here, and the slightly better news to people that the government's been giving out money. So potentially employed have benefited from that. But with that, there are going to come some issues. We're expecting there being perhaps some surprises for self-employed when it comes to doing the 2021 taxes. So what should they be bearing in mind at this moment in time?
Yeah, no, definitely. So thinking specifically to start with the self-employment income support scheme grant, it is a very positive step that the government took for the 3 grants that have been paid to date, with the 4th one coming very shortly. The HMRC have confirmed that the grant income will be reported, at least for the first 3 grants, in tax year 2021. But the twist is, if depending on your accounting year end, if you've got a year end potentially, say April or May of 2020, you are going to have the full year's worth of profits from the trade and all of the money that you've had from the grant income. So although the grant was there to assist you throughout the year, the tax bill associated with that could be significantly higher than people may be anticipating.
Yeah, you could see how that could be particularly difficult. Have we got any ideas how we might be able to prevent some people with year ends which are, say, April, May, June, potentially avoid, I suppose, a perfect storm in terms of tax liabilities?
Yeah, there is limitation to what we can do, but something that would initially be looked at is the accounting year end, and in potentially moving the accounting year end, looking at the effect that has on the overall assessable profits when taking in consideration any overlap profits that are or have been brought forward. But that's something that we would need to assess on a case by case basis. But there is scope to be able to at least mitigate it somewhat.
Yeah, and also I suppose for anyone who's used to having tax deducted at source, say through CIS, if they've been getting a grant, then that might impact on the normal dynamic.
Yeah, absolutely. So they will be used to having the tax withheld at source on the monies that they've received, and with that grant income, that is going to them gross. So hopefully they're not spending every penny they've got, as there is obviously a tax that will need to be paid with that income. So hopefully people are aware that, at least subcontractors are aware that there is no tax deduction on the grants.
Yeah, so it could well be worth just making sure you know what your liability is going to be like come next January. So at least you're prepared and
get it done early.
Keep the money by.
Yeah,
absolutely. Actually, just one final thing on that. Is that at the moment we know grants 1, 2, and 3 are going to have to be declared in the 2021 tax return, but it's not yet actually been confirmed, as far as I'm aware, whether grant 4 is going to have to be included in this tax year's return as well, has it?
Not that I've seen, no. So HMRC confirmed for 2021 there would be a specific entry on the self-assessment return, which the grant income would specifically go in. So that would be a new part to the return. At the moment, as it stands, they may roll that over to 21-22 to cover that 4th grant. But I think at the moment, it potentially could fall down to the timing of when that money comes in. But again,
yes, the period for the 4th grant will actually overlap the 2 tax years.
Yeah.
So my way of thinking would be, if it is to be determined that the tax point's to be determined when it's paid, then there could be a benefit as long as you can hang in there for a bit longer of just waiting to apply for the grant to make sure we're paying for the next week.
Yeah, absolutely. And if in delaying claiming and receiving the grant, potentially that will mitigate the issue we've just previously spoke about to some degree, and that you're not putting 4 grants into 2021 and a whole year's set of profits. So yeah, if that's possible, it's definitely something worth thinking about carefully.
But no doubt there'll be clarification on that point in the next couple of weeks. So we'll watch the space.
Yeah, it's definitely coming soon. Okay, similar sort of train of thought then, but this time looking at company owners as opposed to the self-employed. In terms of their remuneration, and being mindful that it's coming to the year end and for 21-22, what should they be thinking about in terms of sort of planning and thinking about the company structures and so on?
Yeah, so the main thing we're going to look at is that money's being taken out in a tax effective manner. So with that, we'll normally have a strategy in place, say for owners of small companies, which could be taking a salary out up to a point where national insurance kicks in, and then taking dividend income. But with that as well, it's always worth considering, because we've got family-owned businesses, to make sure that shareholdings are appropriately distributed. So potentially, if you've got one person as a main driving force, you've got to be a bit. But there's no reason why potentially a spouse couldn't have an interest in the business as well. Indeed, we think it'd be rather sensible to have a second director, second person, and second decision maker, which would then justify paying a salary and having a shareholding on board. And potentially, even if you've got adult children, maybe if you're funding through university as well, why not provide them with some shares so that they can also receive dividends? The name of the game here would be to ensure, let's say, the dividend allowance is taken up, which is gives an option of £2,000 tax-free income. So that can be spread across a number of people within the same family. And in the case of adult children, if you are going to flip out on their behalf anyway, them to go to university, why not just let them have the income, and they can pay their own bills? So you've got to be careful with other aspects there as well, like control and voting rights. But there's certainly things which can happen. And also, as well, maybe other sources of income. Talking about a dividend allowance there, but you might have a look. Can you take advantage of, say, some of the savings allowance? If you put money into a company, then you can probably justify charging interest, and then that interest can come out, and maybe you can offset that against beneficial rate of income as well.
I suppose with some sort of planning, you can, as you said, utilize dividend allowance, savings allowance, starting rate allowance, and you can certainly accrue a nice wedge there, tax-free.
Yeah, absolutely. I mean, you can come up with a scenario. I mean, it depends on the circumstances being favourable, but you can actually structure things so that you can get significant sums of money out without actually having to pay too much tax, which is obviously could be of quite significant interest. But you can come up with quite different answers. And there are other aspects as well, as we're heading towards the end of, say, maybe if a business is minded to incur some expenditure, can it do so before the end of the tax year? Could there be any benefit to, say, throwing some money into a pension scheme? We're going to talk more about that later as well. But a number of aspects that you can think about from a company's point of view as well.
Yeah, absolutely. Well, as you mentioned it, good time to talk about pension planning.
So with pensions, what's quite striking is the fact there have been numerous changes over a number of recent years. So perhaps a good starting point is just to give an overview of what the rules are now.
Yeah, absolutely. So the standard allowance still remains at 40,000. The threshold income has been increased from 110,000 up to 200,000. And then the critical one, the adjusted income limit, is moved from 150,000 up to 240,000. The importance there is most people traditionally would be quite careful with the amount they contribute to the pension, being mindful that if their income was at such a level where there would be an abatement to the 40,000 allowance, potentially it could have been reduced to 10. So those individuals maybe want to look again at how much they can put into their pension going forward, as there is considerably more flexibility now to build up that pension fund.
Yeah, and also with I've mentioned before about tax rises being likely in the near distant future. Pensions is an area where there's been massive subsidies from the government in terms of tax reliefs. I think I was even seeing something this morning indicating that the amount of pension tax relief that's been given out this year is a lot more than in previous years. Yeah. So can this be sustained?
Well, possibly not. And I suppose maybe an indicator to that is the previous minimum allowance that people could get was 10,000. And for 2021, that's been brought down to 4,000. So although not a huge change, it could be a sign of the direction of travel on what the government may be thinking at the moment. So potentially, if you have got brought forward allowances for the previous 3 tax years that you haven't used, definitely use them whilst you can, if you've got the money to do so.
Yeah, and as a general exercise, as you mentioned there, it can be quite complicated actually working out what your entitlement is. So maybe just get someone to work out what allowances you've got spare, and then contemplate whether making a significant pension contribution before the end of the tax year is a good idea or not.
Yeah, absolutely. And even if it's not you personally making one, going back to the remuneration for companies, if you're a director, making the company make the payment for you, or if you're on really good terms with your employer, potentially looking at them boosting the contributions. But as long as it's all looked in the round at what you contribute and what they do as an employer, as long as you're below the limit, definitely a good strategy. So the next one, again, there also has been big changes this year for capital gains tax, hasn't there?
Yeah, the big changes has come in terms of certain compliance requirements. Some people have to make immediate capital gains tax returns. Could you just elaborate on that for us, please?
Yeah, absolutely. So most people will be familiar with paying their capital gains tax at the same time they would maybe have done their self-assessment, so the 31st of January following the end of the tax year. Now, specifically with capital gains tax on residential property, starting from 2021, HMRC are now requiring that the capital gains tax is reported and paid within 30 days of the property sale. So that is obviously considerably shorter than the time people were previously afforded. The positive bit is it doesn't relate to commercial transactions. And if you have a mixed use property, say shop downstairs, flat upstairs, it is only the residential slice that at the moment you need to report. But given the tight time frame, not all solicitors are forthcoming with this change. For selling a property, definitely get in touch with your accountant.
Absolutely, and penalties will apply if you don't comply with the regulations. So you just don't want to pay money across the HMRC unnecessarily. If we're then thinking in more orthodox terms, as we're coming towards the end of the tax year, what might some general tips be, particularly if people, let's say, have a portfolio of shares?
Yeah, absolutely. So as the point on the slide is using annual exemptions, so 12,300, any gains within that band are tax-free. So if you have got shares that you can dispose of and you want to, by all means, utilise that allowance. If you've got shares that are potentially of negligible value, there is a mechanism to potentially crystallise any losses if you wanted to utilise it, any losses that you've accrued. Things about bed and breakfasting to be mindful of is the way HMRC look at the sale and acquisition of shares, and in connection with the pooling rules, it's something to be careful of if you're selling and subsequently reacquiring the same class of shares within a period of time. You may fall foul with some sort of anti-avoidance rules. The other idea I think we spoke about previously was the bed and ISA, where potentially selling shares into an ISA wrapper, and that being a particularly tax efficient mechanism for people who potentially are not maxing out those efficient investments.
Yeah, that's definitely something that's worth looking at, because you can get the advantage of crystallising gains against annual exemptions and then moving a shareholding which might still be doing fairly well into a tax-free environment. So always with those kind of things in particular as well, worth getting a bit of financial advice, but there's some good options where you can combine some useful tax savings with some investment advice and make your investments work well for you, hopefully.
Well, absolutely. So I think that's that one. The next one is not specific to any particular point. So I suppose to round things out and maybe cover off things we haven't already looked at, what would you say are, sort of expanding on the previous thing, the general things people need to be thinking about, and it may be the obvious ones that sometimes slip people's minds?
Yes, it's worth. There might be a degree of repetition, but it's worth going over the basic points again, because in different contexts, it's kind of apply. So, looking at tax planning, basically what I'm trying to do is make sure that people are making full use of tax balances that are available. Um, we've talked about it from businesses' point of view, but from individuals as well. What I'd say is, particularly with married couples, make sure that your income is equalised as best as possible. So, particularly if you've got investments generating income, or let's say a property, if you've got one spouse earning more than another,
Yeah,
are you still making use of both your personal allowances? Can you use a dividend allowance? Can you use a savings allowance? But at the very least, are you both able to use your basic rate entitlement? So it's just things like that, making sure, taking advantage of the tax rules as they are, and with husband and wife, move assets around without any consequence. It's quite easy to spread things around, and look at yourself jointly, and how that impacts household income. Could be a sensible thing to do.
yeah,
The other
absolutely.
main area, which we would tend to look at, so you get some pretty nasty tax rates, marginal tax rates, and for those who are in receipt of child benefit, it seems a higher earner goes over £50,000. Child benefit has to be repaid on a tapering basis. And also, as soon as income goes over £100,000, the personal tax allowance is withdrawn by £1 for every £2 you go over, which
Yeah,
creates a pretty nasty effective tax rate of 60%.
yeah,
So if you're going to be approaching either of those um, bands, marginal tax rate bands, then is there anything that can be done before the end of the tax year? Again, that again perhaps goes to something like pension planning,
yeah.
because making pension contributions can actually impact on what your net income is for determining whether personal allowances get removed, or gone over a child benefit limit. So it's worth looking at that, and potentially even
Yeah,
charitable
absolutely.
gifts as well.
Yeah, absolutely. And I suppose that point about charitable gifts is the bad, as we've listed it there, is to just be mindful that if you are making donations that do qualify for gift aid relief, and you do make that election, ensure that you have got sufficient, you are paying sufficient tax to cover those, the 20% credit that HMRC are paying on your behalf, just so you don't get a nasty shock at the end of the year when you have to pay it potentially.
Yeah, that's a very good point as well, because I think some people might go onto autopilot without having been taxpayers in the past. And again, if you've got a married couple, make sure any gift aid declarations in the name, if only one of you is a taxpayer, put it in
Yeah,
the name of one who's a taxpayer, because if you make a declaration, if you haven't paid tax, HMRC get the detail and the information, they'll check.
yeah,
And so if they've then passed a 20% tax to charity and you haven't paid it in the first place, they're going to go back to you and ask for that money.
not good. No, you don't want that. Okay, so looking forward then to next week and the budget. I think there's been discussions in the news as to the particular tax that we think may be affected. But you got any thoughts going into next week that what people should be thinking about?
Yeah, we've had various rumours, but I think by and large, maybe it's the government keep their cards close to their chest and might not have made any final decisions until quite late in the day. So we're never going to know for sure. But where there has been lots of speculations, things like capital tax, and that made sense to me as well, because with where we're at the moment, it would make sense to maybe look at transactional based taxes first, because in theory people have received money and so would be in a position to pay that kind of tax. And also potentially with tax reliefs, you might just claw those back a bit, so restrict what you're giving out. But it is likely that will increase. The other thing I've read recently is it's been speculated that corporation tax, for instance, might be put up by 1% a year for maybe 4 consecutive years. And again, I think it would be sensible to bring these changes in gradually rather than anything too drastic, because that always tends to have adverse effects as people try and react and to avoid changes where possible. Capital gains taxes would seem to be one in particular that is likely to change before long. So anyone who is potentially in a position to help might be advisable to try and if you've got anyone doing the legalities for you, try and get them to move on just in case.
Yeah, absolutely. And I think I saw one of your slides earlier, which was a really good line, saying use it before you lose it. At the moment, people know what the rates are, they know what they're entitled to. So if there is flexibility in there, maybe obviously definitely consider utilising it. I think there's been discussions in the last couple of days that Chancellor may not want to cause a short, sharp shock in raising things too quickly, but you don't know. Some action needs to be taken, so maybe not to hedge your bets.
Absolutely, and it might target specific areas. So it could be things like national insurance for the self-employed, or taxation of dividends for those with small companies. So if you are in a position you've got cash in the company, then take it as income now potentially, or like we said with pension contributions, now could be a time for doing something like that, because we know what we're dealing with at the moment, and the chances are you're not going to get better rates or better treatment in the near future.
Yeah, be dreaming you think maybe it won't go down. Unlikely, but okay. I think that's the last slide. So thank you from me. Thanks for watching.
If you made it to the end, well done, and thank you very much. We have got some notes which I believe will be available as a link, and also I'm sure I'll speak for Shaun as well as myself. We do actually get something of a buzz if we are able to save people tax and mitigate liability. So please do get in touch if there is anything here that's of interest. We'd like to hear from you and see if we can help and explain and guide you through some of these.
Yeah, absolutely. Yeah, thank you again from me.
See you later. Bye.